Welcome to Behind the Research, a video series on the latest reports of the Commercial Real Estate Development Association Research Foundation. I'm Shawn Moura, the Foundation's Executive Director, and I'm joined today by one of our distinguished fellows, Spencer Robinson. We'll be discussing some of the topics in managing physical risk in commercial real estate, a report that Spencer recently co-authored with C.G. Zhang at MIT Center for Real Estate, and which is available at creatorresearch.foundation. Thanks for joining us, Spencer.
Thanks, Sean. Happy to be here.
So this report examines how developers, investors, and tenants approach physical risk. In a nutshell, what is physical risk?
Sean, before I define it formally, I'm going to open with this concept and I might repeat it. Real estate's always been a business of risk assessment, tenant risk, location risk, financial risk. The message that the report really communicates is that physical risk is now one of this bundle of risk. It's not more, it's not less, but it's one of the factors we should consider when investing and owning in real estate. Physical risk is simply the risk that weather and climate hazards damage property or disrupt operations. Formally, we separate risk into acute risk, which are events like flood, hurricane, wildfire, etc., and chronic risks, which are long-term issues like chronic heat and sea level rise. For commercial real estate, it's more than just whether a building floods. We need to consider whether employees can reach the site, whether the power stays on, whether insurance remains available and affordable, and ultimately, whether the property continues to perform financially.
Great. And then when it comes to how the commercial real estate industry is approaching physical risk, how's the industry currently assessing and managing it? And how's that changed in recent years?
Sean, what's changed most is awareness. Now, one of the interviewees that we quoted in the report said, there's been a wake-up call. Many things we used to take for granted are no longer things we should take for granted. Fires, floods. It's never going to happen to me until it does. And now that people are becoming more aware, today firms are incorporating multiple sources of information. They're laying traditional engineering due diligence, insurance market signals, local experience, and increasingly these forward-looking climate analytics. These are the forward-looking projections that estimate risk based on climate scenarios rather than backward-looking data on what has happened. At this point, using these forward climate risk analytics is pretty much standard practice for institutional capital. So for the rest of the market, 5 years ago, the question was, should we even look at this? Today, the question is, how do we start integrating all these different sources of information, what I've historically used, the new tools, into investment decisions that benefit our clients and our investors?
And as you are aware, property insurance premiums had been rising quite rapidly just a couple of years ago, but have since leveled off in most markets. You think there are still strong financial motives for the real estate industry to do more to manage physical risk?
Sean, absolutely. Premium growth has moderated in insurance, but this is just one input to the financial performance of building. As I mentioned earlier, physical risk should now be considered part of this bundle of risk. I recently published an article in the Appraisal Journal, which now allows appraisers to consider physical climate risk where appropriate. In it, I outline multiple channels this risk impacts value. For example, NOI can be impacted by HVAC, water stress, business interruption in the short term. And if areas we're in or are considering are impacted by chronic risk in the long term, like chronic heat or sea level rise, how does that impact long-term demand, which may influence rent again in the longer term? So, in other areas include flood proofing, fire hardening, and other resilience measures that are becoming more and more necessary and impact CapEx. So CapEx is a cost of acquisition or in the ownership and management of the building. Cap rates, as we know, are reflections of risk. The institutional markets are already seeing physical risk reflected in cap rates, and I expect those pricing signals to become more widespread across the industry. So, yes, aside from the motive to protect the asset and the people in it, I think we will increasingly see the direct financial impact of improved building resilience against physical risk.
The report observed that insurance companies, institutional investors, tenants, and developers approach physical risk differently and have different risk tolerances. What do developers need to know about how other sectors of the industry address these risks?
Sean, that's a great question. Each stakeholder has a different lens. So insurance companies are going to ask, what could happen at this site where I'm at risk? Right? Institutional capital asks, will this investment meet my fiduciary and investor goals, which may include ESG goals? Right? The tenants are going to ask, can I keep operating my business and keep serving my clients? Developers have always had to understand multiple perspectives. Understanding this risk is no different, right? How can developers really start to look at the structure with insurers who look at the COPE inputs, construction, occupancy, protection, and exposure? If they're working with institutional capital, what's the time horizon we're looking at? Is it a core fund with a 15-year horizon? Because that may act differently than a 3 to 7 year fund with a shorter horizon. Right? What reporting requirements do they have? And most importantly, how does physical risk impact the overall project risk and expected return? But from the tenant perspective, they're less interested in the value of the real estate. They're primarily interested in operating their business. The developers need to start understanding at a higher level how to mitigate downtime, provide access, and effectively serve these tenants. So increasingly, developers who can understand these multiple perspectives and bring them into a solution will acquire premium and credit tenants, high-end investors, and increase the overall value of the asset.
How are the developers and building owners you spoke with currently balancing the costs and benefits of making buildings more resilient?
So developers want to invest in building features that generate a return. That's natural and normal for the industry. But the challenge is, how do we assess return against uncertainty? If we spend $500,000 on flood mitigation, how do we measure if that came in a return? Is the building worth more? Do we get more rent? I think, Sean, over the next 5 to 10 years, we'll see developers who make those choices get increasingly rewarded. Today, most developers look to meet the code requirements, but typically not beyond that. It's a really competitive market, and it's hard to justify these uncertain returns that may or may not happen in the future. But part of this doesn't have to cost a lot of money. Better information often changes decisions before construction even begins. Understanding the risk at a site may lead you to choose a different site, adjust the grading, relocate equipment, negotiate leases differently. Um, some of the hazards can be mitigated with operational habits like vegetation management. Some like flood can be mitigated a little bit better with site and or building level resilience. The report gives a lot of detail, and I'd recommend listeners look to that report for more detail.
Thank you for your time, Spencer. As you mentioned, if viewers would like more information about managing physical risk, they can check out the full report and all of the Research Foundation's report at creatorresearch.foundation.
Thank you, Sean. Parting message, if there's one takeaway from the report, physical risk should now be considered alongside every other major investment risk. It isn't replacing traditional real estate fundamentals, but it's now one of them.
Thanks, Spencer.
Thanks, Sean.